What happens when Singapore's stock market hits new highs, but a few standout blue-chip stocks lag behind? In October, while the Straits Times Index marched to record levels, three major names, Seatrium, Jardine Matheson, and Hongkong Land, fell sharply, raising eyebrows across the investment community. Could these so-called fallen giants be signaling risks, opportunities, or simply a new chapter in the market story? Before jumping in, a quick financial disclaimer. This video is for informational purposes only. The content does not constitute investment advice, and viewers should perform their own due diligence or consult a financial professional before making any investment decisions. No recommendations to buy, sell, or hold any securities will be provided in this analysis. Let's set the stage. October 2025 saw Singapore's STI, Straits Times Index, reach a fresh high of 4,520 points, with bank stocks like DBS, OCBC, and Singtel supporting the rally. But beneath the surface, select blue chips diverged with notable negative returns. Institutional flows poured in, MAS kept its policy steady, and Singapore's GDP growth outpaced expectations, yet headwinds remained from global tariffs, currency volatility, and regional uncertainties. Seatrium posted the worst October performance among STI constituents, dropping over 10% despite reporting a threefold jump in net profit for the first half of the year. Revenue surged 34%, margins improved, and its $18.6 billion order book stretches through 2031. So why the disconnect? The market spotlighted cash flows and dividend sustainability. Despite operational improvements, negative free cash flow and intense competition in shipbuilding kept sentiment weak. Volatility surged as investors worried about execution risks and energy market swings. Seatrium's story highlights just how much market sentiment can differ from accounting results. Hongkong Land, trading at an extraordinary 56% discount to its net asset value, saw a 5% decline in October. Underlying profits improved thanks to Singapore office completions and China residential handovers, but ongoing losses in development properties and nearly $300 million in impairment charges in China weighed on the share price. Strategic portfolio transformation, asset sales, and a focus on ultra-premium properties are underway, but skepticism persists over near-term execution risks. The current dividend yield of 3.8% trails Singapore's REIT average, drawing value hunters, yet the China property sector's challenges loom large. Jardine Matheson slipped about 2.7% after a strong year-to-date run. With conglomerate discount pressures, profit growth in its businesses, and capital allocation moves like a $250 million buyback and Mandarin Oriental privatization, the group remains diversified. However, complexity, Indonesia exposure, and China property concerns hang over the stock. Despite 45% profit growth and a defensive dividend yield, structural discount and market skepticism continue to influence its valuation. Comparing these fallen giants, Seatrium's price-to-earnings ratio stands at 26.8 times, while Jardine Matheson is just 1.85 times. Hongkong Land's price-to-book is 0.45, evidence of deep value perceptions amid operational difficulties. All face heightened volatility and unique risk profiles, from cash flow sustainability to sector-wide headwinds. Singapore's broader market was resilient, fueled by financial sector strength and improved economic numbers. Main risks revolved around rate cycles, geopolitical tensions, and sectoral challenges. Shipbuilding faces cyclical uncertainty and competition from Korean and Chinese shipyards. Hongkong Land contends with China's property market turmoil and Hong Kong office oversupply. Jardine Matheson's fortunes weave through consumer markets, hospitality, and regional industrial cycles. Macroeconomic tailwinds, such as lower interest rates and stabilized inflation, helped some segments but didn't uniformly lift all boats. For institutional investors, risks are front and center. For Seatrium, project execution, negative cash flows, oil price shocks. For Hongkong Land, China sector woes, Hong Kong political and tenant risk, refinancing pressures. For Jardine Matheson, conglomerate structure complexity, regional exposure, currency volatility. Market behaviors suggest that structural issues, not just quarterly numbers, can drive performance, and these risks should be closely monitored into 2026. What could catalyze a turnaround or deepen the decline? For Seatrium, watch for new project wins, cash flow improvement, and dividend policy updates. Hongkong Land's asset sales and capital deployment could trigger value realization if execution meets expectations. Jardine Matheson's restructuring moves and Southeast Asia exposure will be in focus as the group pivots following its buyback and privatization efforts. Broader market shifts, institutional flows, and policy stability will all shape the months ahead. October's fallen giants present a landscape rich with both caution and potential. With the STI at record highs and select blue chips lagging, investors see a choice: avoid perceived value traps or position for contrary opportunities, while always keeping risk management front and center. The story of Seatrium, Hongkong Land, and Jardine Matheson reflect the nuances of market cycles, business execution, and investor psychology. Remember, this analysis is strictly informational, not actionable advice. For those watching Singapore's markets, October's divergences offer powerful lessons and plenty of insights for the months ahead. Thanks for watching. If you found these deep dive insights useful, don't forget to like and subscribe for more market analysis and financial research tailored for Singapore and regional stocks. Stay informed and see you next time.